Okay, I think I've been given the go ahead to start. So today's topic is another interesting topic, and is are MFs doing the right thing? So a lot of mutual fund in money, has come into the system. We are at somewhere around 59 lakh crore. That's the AUM, and it's been growing, and all of us have been contributing, and you have been contributing. So let's take some stock as to where the money has gone, how the money has been, been used. Uh, what are the sectors that they're looking at. This is not going to be stock specific, so don't expect that there will be some stock specific information that comes here, but we will take a broad based understanding of how things are and where the money has been going, and is that money really actually making money, or what is the consensus view right now, right? So again, we'll start off with the same, one of the favorite charts that we have. So how do market cycles work? And this is one of those few presentations where I have not put a poll. You'll just have probably one question that comes in, but there's no poll. It's just information. It's just data. So it might get a little boring. And if it does get boring, just put your hand up. I'll stop for some time. We can have a conversation apart from this. We can have another conversation, whatever questions you want. We can move on to Q&A also if that is okay. And so don't expect that there'll be a poll, right? It might be a little boring, right? So how do market cycles work, right? So market cycles work always in over optimism and pessimism, and we are currently in a place where optimism is high, and usually in cases of over optimism where everything is doing extremely well, you will come and see stuff on Twitter saying, hey, why don't you do this? Buy this. I made 10x on this, 15x on this. One day return 20%, one day return 18%, one day 10%. There'll be a clapping hand emoji, everything of that sort. Your neighbor would come and tell you that, you should be buying this. Why are you doing this? Like I did this. Why don't you do this? So it's not going to work for everybody. But yeah, whatever has worked has led to over optimism, and that further leads into greed. Right? That's when everybody comes and tells you buy, buy, buy. Now, when the flip happens, right, when cycles turn, when things start to look extremely bad, a lot of fear starts coming in, and everybody tells you, no, I think you should stay from all these things. It's not meant for you. Let's take a back step, take a breather. Everybody will tell you sell, 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 right? So this is how long-term market cycles work, and this is in terms of sentiment. Now, why the sentiment moves up and down is because capital cycles work like that. So long-term capital cycles also play out in that manner, where there is optimism, where there's a lot of money that gets committed for capacity addition, and then that utilization levels are not very high. Demand goes down, supply comes up. All those scenarios start taking place. Likewise, that leads into sentiment cycles, and that sentiment cycles are majorly greed and fear. So what does Milestones to Wealth actually do for investors? Now, we are a behavior oriented model. We are not a platform that gives you buy and sell recommendations. It's a proper behavior model where our first step is to create a savings habit, make you aware of how financially fit you are, right? Create a savings habit. Only then that would lead into you creating an investing habit, right? So the first step is always going to be making sure that your first line of defense is well covered. It's a very holistic approach to building wealth. Your first line of defense will always be insurance. So to ensure that you're financially fit, that analysis of whether there is a gap in terms of your insurance, one is met. Second, once you figure out that yes, your first line is done, that's when we start going into analyzing what your goals are and how much money would you require to meet that particular goal, and depending on the time that you have, right? So it's going to be goal based, it's going to be milestone based, right? Milestone is what you said, it's 50 lakhs, 20 lakhs, but we have set that sort of target for every investor that we want to work with is more from a 1 crore perspective. So we have set that target that every investor that we work with will be able to save 1 crore, right? So how are we able to do that is managing behavior. And in a boring market where everybody is talking about sell, 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 is where your participation levels actually have to go up, right? It's not the other way where you exit and try to time things in out. It's just being consistent, right? So boring market is when your participation levels need to be a lot more higher than what it would be in an exciting market. Usually it's the flip, right? In an exciting market, you are very happy to go out and start participating because you see a lot of confidence. But it's the flip always. Being confident works. And in a boring market is when you have to see your participation levels go up. Your participation has to come in from lump sum, SIP, step up. Your contributions basically need to get amped up. Right. Only then when an exciting market comes in is when you will be able to reap the benefits. Now exciting markets will keep on coming, but whether will you be able to reap those benefits? Your benefits will only get reaped once your goal is met, or when things have looked extremely rosy good. There's high level of optimism in the market, uh, and that's where you'll be able to sort of reap the benefits. But until then, you will be at it consistently, showing discipline in your wealth creation journey. That's the behavior model for milestones to wealth. Right now, this is another chart that I said I thought that yes, from here on I should be putting, because this is where your savings actually, you get a clear understanding of how much you're able to save over a long period of time, right? uh, your priorities come in, but you have a very short time up until your working age, and after that the money that you've saved must be working for you, right? So if you look at this, up until 40 is where you max out. 40 to 45 is where you're maxed out. Say, okay, beyond this, I am very close to my retirement, and after that, you might want to retire at 50, you might want to retire by 55, right? But the point is that yes, from there on your mindset changes into, I want to take a step back, and I want to live off the money that I saved, and that money should make me money, right? So you have a finite period to save for your investment goals. That doesn't mean that you cannot reach that particular target of 1 crore. Of course you can. It takes you about, if you're being consistent, it will take you about 10 years or so, to reach that 1 crore. But when you set that target for 1 crore, our aim is for you to grow higher, aim bigger. That 1 crore will eventually lead you into you aiming for 5 crores. Right. So I've done that particular webinar, I think it was last week, where we were seeing how you can get to that journey of 1 crore. So I think after the webinar you must go to YouTube Milestones2Wealth, and then you'll get all our webinars there, right? So now let's head into the presentation, right? So if you look at this, we've been saving more, right? Our gross individual financial savings has gone up, right? In relation to that, and all of this is public data, right? So your net inflows usually loosely track your financial savings with some lead or lag, right? So here, if you see, India is becoming more and more mature. Our participation levels are going more and more into financial assets, are going more and more into savings vehicle like mutual funds, right? Maybe not even mutual funds, but it's still going into financial assets. So if you see here, right, we are aspirational, we are growing. And if you remember that I had done a consumption webinar to see that yes, where are the opportunities for us in consumption. So we are at an inflection point in terms of per capita income growth. So we are going to cross that threshold, right? Which means that we are going to save more, and as we are going to spend more, which means that savings obviously has to go up for us to go and spend more, right? So we are saving a lot more than what we used to, and all of that money is definitely going into financial assets, and you can see that trend here, right? And where is it going? It is majorly going only towards equity. This is slightly dated, but if you look at the split, a majority of the money, right, just continuously keeps going into equity, right? So everybody has been following a particular herd, and a lot of money has only flowed into equity. So you look at the other asset classes, right? Forget liquid. Liquid is something that has a tendency to go anywhere. Passives is very small, but though a lot of innovation comes on the passive side, so and majorly it is driven by your folios are driven by retail, but the AUM is driven by corporates. So a lot of money there is innovative. It's still nascent. So you look at the active management part. The active management part has grown drastically, and a lot of money has flown there. Right? But you look at debt. Debt has not grown at all, very strongly. Right. So a lot of opportunity is opening up on the debt side, but a lot of money continuously has been flowing into equity. The majority of the money has gone into equity. Now, where has it been going on the equity side? So if you see here also, FY24 has been one of the strongest years for mutual fund flows in history. So if you look at it from 2008 in history, right, we've had one of the strongest flows, right? So if you look at the FY24 data, you are seeing some debt coming back into the system, right? But if you see back in 2010, 11, 12, 13 history, like ever since 14 has after 14 is where equity started to come into the picture, right? But it was majorly debt driven. Again, you saw 21, a lot of money came out and has been going into debt. But since then, debt has not actually gotten a lot of inflow, right? But you're seeing here in India that you are getting opportunities to invest in a lot of money that if you were reading the newspaper, we were getting included in the global bond indices, and a lot of money has actually come from that also, right? So, your FIs are pulling out money from equity, but they are putting in money into debt. So debt is coming up strong. So if you look at the 2 months also, the data that's showing here is that yes, there is money going into debt, there is money going to liquid. So smart money is actually moving, right? Smart money has actually started to move across asset classes, but a broad base of the entire market, the entire industry is still equity heavy, and a lot of money has flown to equities, right? So even if you look at your SIP, right, your SIP as a percentage of active equity AUM also has been going up, right? So it was 26%, now it's 37%. A lot of money again. This is consistency, right? This is where your chart is that will make your financial journey a lot more easier than what it used to be back between 2010 until 2018, right? Those were different years, and now we're seeing different years. Today, when volatility comes in, it's just being grabbed like this, right? You saw on the day of uh, the election 2 days, and then today we are at an all-time high. So you don't get time. Consistency doesn't give you that sort of. If you try to time the market and sitting out in the sidelines, you're never going to get that opportunity because it has to be very, very quick. And SIP is the best way for you to be consistent and be able to time that. You don't need to time it. You just need to go out and start investing, right? You always need to be consistent without seeing something. I think there's a comment saying can't see my screen. Just send me a thumbs up because I don't know this. You're having too many technology oriented problems these days. Just send me a thumbs up if you can see my screen. So much for AI. Nice. Yeah. So you're seeing that a lot of money, even in the SIP part, is going into equity, and that is fair because being consistent is the only way where you can sort of go and build wealth. But it's an all-time high. SIP AUM now is 1/3 of the entire equity AUM. 1/3 of the entire equity is being consistent. So what is stopping you from being consistent? I don't think something should stop you from being consistent, right? If you look at monthly flows, all this data, I think right? You look at the left part of the chart. It's again somewhere around 22,000 crores, which is going in as monthly. But what I want you to see is that we've had a lot of discontinued SIPs. As the SIP new registered SIP number starts going up, you're also seeing a lot of discontinuation that's happening. Now, there's no particular, I haven't found a particular reason, but usually from a practical sense, we do see some sort of bank issue, some sort of mandate issue, some sort of, that SIP has been missed for 3 months. So a lot of it is also being captured in the discontinued SIP. It's not alone the fact that the markets have peaked out and a lot of people have thought that yes, this is a time for me to take out my money. No, there's a lot of other reasons also that are practical reasons through which the SIP does not go through, and you're seeing a lot of discontinuation that is happening in the entire industry. So net addition for the last couple of months have not been that strong, but the gross number that is coming in, the new registered number also that's coming in, is extremely strong. Now, one reason that makes me believe that yes, the discontinuation is, part of, let's say, there are a lot of other reasons that are there, not just speaking out, is because most of the money in the equity AUM is just 2.5 years old. That money has been going up. I mean, that age has been going up. That yes, 55% is now more than 2 years old. But if you look at it, a lot of money has come in only in the last 2.5 years. A lot of new folios have come in only the last 2.5 years, right? With the assumption that yes, we will have another doubler that can come in, like 50%, 60%, 70%. That usually does not happen. It's very abnormal. But strong growth levels are considered somewhere between 12 and 15%. That's a very good number for you to grow at, right? But the average age of that particular money that is being invested in the last couple of years is just 2.5 years, right? And if you look at majorly, if you look at less than 12 months, right, 1 year, that's 27% of the AUM. 20-30% of the AUM is new, right? It's new. Yeah, that would seep in into more than two as they start aging, but we are having very strong new follow additions that are coming into the entire industry. So there has to be some part that has to age appropriately. That would take some time. Now, where is the money going? Now, this money has continuously been going into small caps and mid caps. So if you see again, now what I wanted to see is, in years like 2023, you are seeing money when going into this is net, going into mid, going into small, going into flexi, going into sectoral. Now, sectoral and thematic right now has seen a jump because you are also seeing a lot of NFOs that are coming in. Right. So the entire of financial year 24, we saw 196 NFOs that were majorly multi-asset driven. As of 2 days back, we have seen 117 NFOs that have come out, and NFOs are gathering a lot of money. You're seeing an NFO coming, and you're seeing a lot of participation also on the NFO side. So yes, a lot of flows have gone in, and X of going into sectoral and thematic, that is NFO. Still, you're seeing very very strong growth coming in on mid and small caps, where a lot of money has been chasing performance. Right? You see the parts where money has not gone in. You see large and mid cap as a category, money has not gone in much. Right? You see large cap as a category, money is coming out. It's not going in at all. Money is going in, but net you're seeing a lot of money coming out and chasing performance. Right. So that's where your opportunity sort of lies when we look at the entire mutual fund industry, where this is a shunned part of the entire industry, where now money is starting to go majorly into large caps. So this is this year, right? If you look at it till March, what is happening? March, April, May, June, you see money still happens to go in mids. There is slowdown that is coming in small. There is money going in large and mid. No, money is also going into multi-cap space, right? So still there is a pocket of the market that is quite large in terms of earnings, that is quite large in terms of what they are contributing to the entire Nifty 500 basket, where a lot of money has not actually gone. Okay, so there is a pocket where investors can actually take advantage of. You're seeing some improvement coming in the large and mid. You're seeing a good improvement coming in on the multi-cap space, right? But no improvement coming majorly on the large cap space. Everywhere else it's okay, and small cap is seeing some bit of slowdown. Right, so that's a good thing for the entire industry right now, where money is not becoming too irrational. You are seeing a lot of irrationality taking place in the entire market, where a lot of money has flown into very expensive parts of the market. Right now, you look at the trends in the top 20 mutual funds by equity value. Now, equity value is all their equity holdings that are there across and their growth, right? So if you see what I have marked in is where the money is going, right, within the entire system, large cap or mid cap or wherever, right? Where is that money sort of flowing in? That money majorly is sort of flowing in into quant. That money is majorly going into PPFAs. That money is majorly going into Motilal. That money is majorly going into Nippon. Right, you're seeing tremendous amount of growth that's coming in terms of equity value there. Right, where's the money not going? Money is not going in UTI, money is not going in Birla, money is not going in Sundaram. Right, just so you're seeing a clear trend here as to where money is sort of going. One, you're chasing small, you're chasing mid, and within that you're trying to again go towards the highest performers in the entire industry. Right, so a lot of money just continuously keeps going that side. Right, whereas there are really good performers that are there in the entire industry where the money has not gone in, right? Money just keep following, it's just keep following performance, right? It's very backward oriented. It's not forward looking at all, right? So you will get such opportunities. There are very strong names. There are very strong players here that are bouncing back extremely strong. Right. So I think I have that number also as to how the bounce back has been for a couple of AMCs in the entire industry. Right. Now this is a very important chart. Here I'll probably spend about another 5-10 minutes. I think there's just a couple of more slides, and if you want me to go through a particular slide also, I'm very happy to go through it after the presentation. But I'm going to leave the floor open for Q&A for a long period of time so that we can interact, and whatever questions you have about the mutual fund industry, you can definitely open up. But here, what you need to see here is where are they going over? Where's your money actually going? One, your majority of the money has been going into small and mids. Second, there is just targeted allocation that are going within, flexi or small and mid or any sectoral or thematic fund. Right, that's where the most of the money has been going. And within those funds, where's there the over allocation that's coming there? Right. So if you look at it from an under allocation point of view, your private banking sector for the entire industry, right? They have been underweight BSE 200. BSE 200 already has a 20% weight towards private bank, but here you are seeing that they are underweight even that allocation, right? Then there is a part where there is extreme under ownership, right? If you look at oil and gas, if you look at consumer, there is drastic under allocation compared to the benchmark, right? If you look at healthcare again has an over allocation. If you look at insurance not so high, but if you compare it to the weight that's there, a lot of AMCs are extremely bullish on the insurance and NBFC side, right? Capital goods has become a complete over ownership across the board, across the entire industry. So a clear trend that's playing out across the entire industry, right? In terms of valuation also, right? As to where is that money actually going to make further money, right? So there is a clear over ownership. There's a clear overweight on the capital goods side. There is clear underweight on oil and gas. If you look at technology, so there is overweight, but there's also underweight. So not a lot of investors or not a lot of AMCs are actually sticking their neck out to go overweight unless and until they have a high conviction on technology. Likewise for telecom, right? You are seeing wherever there is a case for high conviction is where you're seeing overall allocation starting to come in, right? But there's clear trends of under ownership within private banking, within oil and gas, within utilities. There is only some part of the entire market that is extremely bullish on utilities, and there's clear under ownership on the consumer side, right? Whereas there's clear over ownership on the capital goods side, there's clear over ownership on somewhat on healthcare also, right? I would say somewhat on healthcare and on auto as well, right? If you see on the auto side also, you're seeing a lot of over ownership across the entire industry. And all of this is public data. This has been taken from Motilal Oswal's report itself. It's all public. It's available to everybody. So it's just public data. It's nothing that I had to calculate, right? So there's a clear trend that's visible here. Now, if you look at the returns, right, this is what I was talking to you about. Percentage of equity AM that's been outperforming the benchmark on a 3-year and a 5-year basis. Now, this is just for particular AMCs and not for everybody, but it gives you a good sense of what the industry is actually doing, right? So if you look at the largest, right, Nippon, HDFC, and ICICI are the largest. SBI is the largest, but we have data here for HDFC and Nippon. If you look at percentage of equity AUM that has been outperforming the benchmark on a 3-year basis, you're seeing Nippon as an AMC do extremely well. You're seeing HDFC and AMC being consistent in terms of performance, but you are seeing some problem coming in majorly on Birla, and you're seeing something coming on the UTIMC side, right? On a 5-year basis, also you're seeing this very similar trends. That yes, there has been a very good recovery in terms of equity AM outperforming the benchmark on a 5-year basis and on a 3-year basis, right? So active management is working, right? But given the issues that they had during the 17, 18, and 19 years, today we are not having that issue, right? of being constrained only to that particular universe within Nifty 50, Nifty 100, Nifty 250, Nifty 500. So you are seeing a good amount of outperformance that has been happening over the benchmark. So yes, your active management is working. Just for a brief period, it didn't, right? Because of industry related issues that had nothing to do with the fund manager skill or the industry skill, right? It just had to do something with industry regulations, right? Now that issue is behind, and you're seeing that a lot of AUM is going out and outperforming their benchmarks, right? It's quite a high number, is what I would say, right? So I'll ask you a question now. Where do you think is the next opportunity for investors to go out and invest in of a mutual funds? You'll see that trend play out, right? So there's a question on some more facts about debt. I've done a debt webinar, particularly, which you can go through. But do we need to see how people send their money to which fund for us to invest in? Yes, you of course need to see what the trend is, because the way people are investing is they are just going through, either they look it up on value research or any of the platforms give you the top performance based on algorithm. So you need to see where the money is going. That's how you will be contrarian. Why do you need to see money that's where other people are, where the market is going out investing money? Because it gives you a good sense of behavior, right? What is happening? Why is it that money is flowing in that direction? Like for example, uh, 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 2000 to 2010 was a period where it was more infrastructure driven, and again you saw more NFOs coming up on energy and natural resources, and that came right at the peak in 2008, and you saw that particular trend, right? There was a lot of bullishness towards this. So fundamentals matter a lot. If the fundamentals does not support that particular bullishness, then you know that that money is again going to move from momentum to the next momentum, right? So you need to be aware of what is happening in the current market. Why is it that momentum is on one particular side of the market? Why is it that momentum is not on that particular side of the market, right? And then take a conscious call of where you want to be, depending on valuations, depending on what your assumptions for earnings growth is, right? Is BSE 200 standard that needs to be followed by MFs? No, but a majority of AUM, right, is between Nifty 200 only, or I would say 250 also, right? Because we are taking half, right, and majority of the money is only in Nifty 100, right? We are They are just taking 200. They are just taking the top 200 because it gives you a fair idea, because it covers everything. Right? Majorly, it covers all the heavyweights and the top weights. So that's their standard. It's not followed. They have respective benchmarks, but you have to compare to a broad base. So, for example, when you compare debt to equity, how is that relevant? Number one. Number two, when you compare a sectoral fund to a broad-based index fund, again that's wrong, because you have to compare a sector to a sector only, right? So you're just taking a broad-based approach. Various across schemes: energy, power, banking, pharma, energy, banking, private banking. What about metals? Metals is very tricky right now, right? Today India spread is more. So on the metal side, you have to be slightly more cautious. You have to take a very calibrated approach right now. I would say slightly be cautious and slow. But demand is very strong here in India for metals. China continues to keep on producing. They are having their own issues. So we don't know what will happen to that supply. But their production is still happening at the same levels as what it used to happen between 18 and 19. There's no slowdown there. So you can see some bit of problem that can come in on that side, right? But growth is definitely over the long term. You will find that growth coming in here, definitely. Infrastructure, consumer durables. We hear Sham saying railways good for transport, for a good opportunity. How about that? Cyclical, last per chart, all MFs are under ownership in consumer sector. Why? See, it's an expensive sector right now. We've had a period of high inflation, and again patchy rains, and I would agree also that yes, there has been over ownership that came in on that part, and when you burn your fingers and you don't see a lot of growth that comes in, Likewise, where the consensus money moves into something that has been growing. So you're seeing a lot of overweight that has been coming in all the other parts, but that doesn't mean that there's no opportunity here. We've covered uh, consumer also in one of the webinars, and I think that you must go through it because that gives you a clear understanding of how we are evolving as households, right? It used to be a triangle, and then there used to be more households on the bottom. Now that is going up, and we are becoming aspirational, so we will be spending a lot more. So taking a broad based approach to consumption is not a bad idea, right? You just need to have a long term view and be cautious on valuations. Right now valuations, I would say, is somewhat fair. It's not cheap, but it's fair, right? Debt and large cap, I'm surprised to see the under ownership in banking also. So am I, right? So uh, this is again a chart that we had done during the election webinar, and if you see here, just in terms of re-rating, de-rating, and compounding earnings, if you see on the left, right, you're seeing de-rating in earning, declining earnings, and you're seeing a de-rating in multiples. So you're seeing where is that problem that can come in, and you're seeing somewhere where there is opportunity on the banking space, on health, on diversified financials, slightly coming up on the insurance side, right? So you are seeing that yes, there is a pocket in the equity market that investors can take advantage. That's number one. Second, you definitely need to take an advantage on the debt side and on the arbitrage side, right? Third, because I'm for investors who have an alternate to their savings account where you want slightly more, but you want it to be liquid, taxation, you want it to be tax efficient. Definitely, arbitrage comes out for you. If not, debt definitely is that option. Short-term debt still continues to remain extremely attractive. Right. Third is precious metals. Right. Always have a multi-asset approach. I have done multiple webinars on gold, silver, and global mining. So definitely have a look at that. But the your this is a very peculiar situation for investors in India, is because you're having across the board there is not a lot of opportunity, but there is opportunity, right? So things continue to remain extremely expensive. You're seeing gold also going up, but still there's a very good opportunity because of global scenario that's coming up there. You're not seeing a lot of movement that is coming up on the yield side, so it's still within the same 7.2% band, right? So not big opportunity coming, but yes, you know that there is opportunity there. Equity, you know that yes, things are looking extremely expensive. So where is it that I can park my money? Only within parts of the market there, right? If it's within your risk profile, you can tolerate it. Definitely, there's a very good opportunity within that particular segment of the market, right? Again, if you see here, where is it that you're seeing mid to high valuations? You're seeing it in healthcare, you're seeing it in auto, you're seeing it across the board, right? Now, if you see majorly, why I like this particular chart is because it says the sectoral profit pools, as the size of the bubble basically is the contribution to the profit pool, right? You see, private banks are contributing 26%, right, to that particular profit pool, right? But still they are now currently trading at a very good zone for investors to take advantage of, right? Again, somebody said metals, but commodities work different. When the earnings go up, it looks extremely cheap. Suddenly when the earnings does not come down, it looks very expensive, right? So you're seeing one entire big basket that is contributing a lot to the profit pool for Nifty 200, and still remains to be extremely cheap. You're seeing very high valuation there coming up on consumer durables, consumer staples. You're seeing mid sort of valuations compared to what their profit pool is in terms of industrials, in terms of uh, autos, in terms of IT, in terms of healthcare. So not a lot of opportunity there, but definitely opportunity can open up, a couple of years from now. Right now, majority of the opportunity lies only in one part of the market, right? Now let's look at the entire market. Uh, Nothing seems to be in a very attractive. This is based on the earnings yield. So there is not a lot of opportunity that remains on the equity side. So which means hook or crook, you have to look at other opportunities across all the other asset classes until and unless something becomes extremely interesting, or there's a good opportunity that opens up on the equity. Equity may opportunity we already saw, right? But broad based, there's not a lot of opportunity that is coming up on the mid and small cap space or the micro cap space, right? There's not a lot of opportunity, but you're seeing somewhere within the large cap space that you are getting that sort of opportunity, right? So large caps still remain. So I had done last year, I think, a webinar on large caps as an opportunity, and since then they have done extremely well. Of For our investors, they have done extremely well, right? But majorly here, if you see from mid and small cap and micro cap, there's not a lot of option that is available for investors. This is the same level that we saw during the peak of 2016 2017 cycle, and after that, what happened to the entire small and mid cap space. So we don't know how things are going to play out here. Right now, it does look like, yes, there is like a peaking happening or within the cycle. It's extreme optimism that has happened on this particular part of the market. But there are parts of the market where there is a pessimism point, and that I think we've covered. So I think now I'll open the floor for Q&A. We have a good 20 minutes for Q&A. Do you think since per capita income is at an inflection point, consumer durable is preferable? Yes, but since slightly expensive, there you have to take a SIP approach, not a lump sum approach. Is market fairly valued or over fairly valued? With money doubling literally every 5 years, even based on simple index Sensex growth, is this trend here to stay at a long rate? Seems overhype or euphoria is just one-way traffic up in equity now. See, when you're able to grow at 12% on a CAGR basis, you double your money every 6.5 years or something like that. That's the math. Right? So either ways, if you grow even between that range, or money will double, within that 5 to 7 years sort of basket. There will be parts of the market always, be it in debt, be it in precious metals, be it in equity. Wherever you see, there will be pockets of the market that will go through a phase of overhype. That is known. That's how cycles work. And right now, you've seen euphoria in one part of the market and no euphoria in the other parts of the market and in other asset class. So park your money there. Whatever incremental savings you're having, you should not stop investing. That's my whole point. You should not stop saving, but you should, in whatever incremental is what you want to add, you should add towards all the other parts where there's no euphoria, so that you can build that up very well, so that there's some good amount of protection that can happen for you over the long period of time. It's impossible for you to time it, so don't try to time it. How to figure how much P is good for particular earnings growth? I would suggest don't get into that itself. Right? As somebody who has money to save but not a lot of time, you should stick to professionals. We got this question, I think, in the last webinar also. So, and what my suggestion was that no, you always need to have some hand holding and some guidance that can come in, because only they can direct you without you putting in that extra effort. Be honest with yourself. Nobody has the time. If you're in a full-time job that's not in the market, nobody has the time to go through this, and it actually takes a lot of work. Mutual fund, the entire industry has a team of research analysts for every AMC that work day in and day out. To get that particular call right, there's a lot of work that goes into. It's a well-regulated market, and it comes at I think 1.2% sort of cost. So it's very, very cheap. So you're getting high professional advice at a very cheap price. Yet even after that, you see a lot of mistakes taking place in the entire industry. Right. So that in spite of all the work that goes in, some bit always remains. That some bit always remains some sort of a mistake. So if they are also that gap is still there for them to fill. So for somebody who doesn't have the time, should not enter this. Should not think itself of how much PE is good. What you should be thinking about is how much I can save and how much can I increase my savings to in stable asset classes, consistent asset classes. That's it. How do I invest in global miners? There are fund of funds available that you can take advantage of. Market cap to GDP 140%, 5-year high. What about your house view? See, India is currently trading at a fair valuation only. It's still trading at a premium. Whatever growth that, since it's forward looking, all of it has been, a lot of it is factored in now. So there's not a lot of scope for very high re-rating, but there's a lot of scope for negative surprises that can come in. So any negative surprise comes in, might be the reaction might be very adverse, right? But today in India, even if there's an adverse reaction, since we are contributing a lot to the market and we are being consistent as investors, no time. So no time. Can you rate three sectors? Uh, on what basis? We cannot decide MF investment highly based on incoming money to is because SBI, HDFC, they are moving along with their banking customer base. Whereas this opportunity is not there for some AMCs. Share your opinion, please. Uh, See, in terms of parking your money, you always need to park money with somebody who has that experience and the fund management team that has weathered through problems like high inflation or low growth, right? And their research team is very well equipped. They have basically the DNA is very good, right? They have enough experience and have gone through multiple cycles. So when you go through multiple cycles, right, then you're very much equipped to take on whatever comes your way, right? Uh, Today, mandates will obviously be there for them to increase their AUM, but fund houses also work in terms of making sure. See, today a lot of money has gone, right? And a lot of today, if I'm asking you, you are asking me a question, I'm also going to ask a question again to the AMC itself, saying, today we are in this particular scenario. How do you think of it going forward, right? So it's not that nothing is, that goes under the table or goes beyond radar. Everything is very much aware, right? So definite there are mandates that are set, right? But you must be aware of where the money is going. Always you should be aware of where the money is going, right? It's not that you should not be aware of where the money is not going. Only if you know where the money is going is when you will be able to take a rational decision, right? If everybody is going to one particular movie in the theater, right? There are 10 people who say extremely good. Based on that 10, there are 100 other people that go extremely good. Then 1,000 people go extremely good. You don't know actually if it's good or not until you go into it, right? So whenever there is a herd mentality that goes on, that everybody is just following one particular direction, you must question saying why. First thing is why. Why is it that they are following that? Then get on to say yes, be objective. Okay, something is actually good, something is not actually good. Do I need to even take that particular decision or not? Right. That's why you should know where the money is going. Not say that okay, just because the money is going here, I'm not going to go there. No, no, no. Why is the money going there? How can UK investors invest in India market? Uh, you can do via mutual funds itself. There's no problem at all. There are mutual funds, there are PMSs that you can directly take advantage of. You can invest here. There's no uh, nothing is stopping. You can invest, no problem at all. Nor does the AMC stop, nor does you stop. You can invest, no problem. What would be the reason for underallocation in private banking? Private banking went through a very bad period during 18, 19, 20. You saw INFS crisis happen. You saw a lot of defaults that have happened. Then you saw a lot of recap also that has happened, right? That's one. Then after recap COVID scenario, things were looking extremely good because after COVID, nothing happened to our banking system. We were continuously going, right? So digital India came in at full force. So that was one good reason of yes, banks like financial services in India, not only banks, financial services in India do well. Right. After that, what happened is their cost to raise money went down. Right. So naturally, the NIMs came down. So from a fundamental perspective, it became expensive to raise money. Right, and a lot of money has actually gone into mutual funds as well. So it's become difficult to raise money. It's expensive, so that has hurt that sort of balance sheet. But things will definitely normalize from here, and you'll have a new norm that can come in. So book value of banks definitely is going to grow. What makes private banks attractive compared to public banks, even when they are trading below 2.5 is good, no? So where they used to trade on a higher level based on that particular scenario, today it's trading where you're seeing good amount of book value growth coming in. So the B goes up, and the based on that P, the PB looks down. So when B goes up, naturally that's a very good opportunity, for investors to take advantage of. Are there any chances of scam? Of course, there is a chance of scam. How many? So you've seen many front running problems also come in. So you saw recently there was Quant. Before that there was the Axis. Before that there was everybody comes under scrutiny. It's a very high regulated industry. So whatever scam comes definitely gets caught. Right. Today there's a problem. Whatever you touch, be honest. Whatever you touch, there is a possibility of scam. Right? But it's a very high regulated industry. So nothing will happen to your money. Even when there was a very big problem. Uh, uh, Nothing has happened to investor money. But yeah, there's a chance of scam. It's a very high regulated industry. Nowadays, bear market is not staying for long. Is it because people are aware that markets will eventually recover in the long run? If so, in the future, will bear market be more shorter? Sorry. Bear market be more shorter? Will there be more chances for people for this advisory for the market to recover in the long run? I'm not by anyway. See, bear market, I don't know what your definition of bear market is, right? Don't see that 3 days of down is the bear market of any chance, right? Uh, Having said that, any dip is being bought out because participation levels are very high. Right? So in the future, there is a possibility that because our participation depends on our participation level. Our participation level comes off, then you would see that yes, that you might not see that strong of a bull market that can come in. But in the event of a high participation, there might not be that long of a bear market. That might be a very short bear market. That part I agree. Can we stop SIP in small and mid caps and move the SIP to BAF? You think this will help? See, small and mid caps definitely incremental money should not go, and then that should be redirected towards other parts of the market. Right? Depends on your risk profile. If your risk profile can take it, then you may go forward. If it cannot, right? So to know if you're financially fit, if you want to know that you have the risk taking ability to take it or not take it, just send us a hi here. We'll get in touch with you, and we'll do all the tests for you to understand whether you can take it or not, and then we'll take that call. Is front running a serious case for SIP investors? Front running is a serious case whether you're a SIP investor or not. Even if you're a lump sum investor, it's a serious problem, right? Front running. Do you think it's time to exit? Again, it depends on your risk profile. If you can take it, whether you cannot take it, depends on your risk profile. Just send us a hi. Are corporate debt MFs worth getting into? Debt as a part, as an entire basket is extremely interesting. So definitely it is worth a look into. Corporate debt and short term, definitely a worth look into. On consistency and basis of sustainability. Oh, let me go back to that question. Can you rate 3 sectors based on consistency and no? See, there is always be parts where because the cycle works, you might see some parts not do extremely well, right? I think 18, 19, and 20, pharma did not do well, right? That's when we, as capital managers, were allocating more and more money into pharma, right? 2021, pharma did extremely well. Today, again, you're seeing some sort of revival coming up on the pharma space. So everything is cyclical, but over a long period of time, as an investor who saves in India, you should expect somewhere between, if you're having a multi-asset approach, right, your best case is 9 to 12%. Right, 9 to 12% is what you should expect from a very base case scenario. That yes, if I grow at this level, I'm home. I beat FD, I beat inflation, I beat everything else. Your household inflation itself grows somewhere between 11 and 12. So you will be rewarded based on that particular risk that you take by saving into equity or saving into debt. Do you have any funds for small retail salary investors who can invest 5 to 10,000 a month? Or your funds are for PMS? No, Milestones2Wealth is completely mutual fund oriented. PMS is separate. This is a completely mutual fund oriented program. So just send us a hi. Of course, we can help you out. That's what I told. It's not just about funds. It's first step to make sure that your first line of defense is covered so that you and your family don't have a problem. Second, to make sure that you're financially fit. Where is the gap and do we need to fill that gap? To know, to make you aware of what your savings, what your saving potential is, right? And then only we head into investing, right? That's when we get a direction of what we need to take. It's not just, equity or equity mutual funds alone. But on seeing where the money is flowing, can we just short the market? Do you have the appetite to short the market? We feel is not going to sustain, right? No use in that with respect to invest. Why do you think people are not considering HDFC while ICICI is valued more? First question, when you said that, is it better to short the market? Do you have the appetite to short the market? Number one. Number two, do you know who is on the other side of the counter when you short the market? Because that person is a whale, 100% a whale on the other side. Right. So will you sustain is my question if you take that particular call, not the market. Right. Second, HDFC went through, still going through overhangs of the demerger. So naturally, investors' money has not gone there, but you're seeing a good amount of change happening on that side as well. Is India well poised for growth? Yes, when compared to world market, or should we allocate to international market? To international market, there's a lot of problem when it comes to US. So I had done a 401k webinar. That's only for US and Canada because we are also reviewing 401k investments there. Me and my colleague Vinayak do it. Even there, I think it's available online. If it's not, just send us a hi and we'll get in touch with you. But what we noticed also there was that even there, right, everything goes into equity. And they are a far more developed market than us in terms of financial markets, right? All the money goes into equity. Within equity, it just goes into one particular segment of the market. Right? You're not seeing small and mid cap growth there at all. And just in terms of comparison between small and mid cap in the international markets, they are trading at a deep discount to their large cap peers. Right? And it's rightful so for them to trade at that deep discount valuation because there's no growth that is available from a broader sense. Interest rates at those levels have hurt the economy and has hurt every single industry there. So consumption industry in the US is slowing down, right? So India is the only country that is offering 7.5% GDP growth, right? So in the international market, you have to be very picky. Everywhere now it has become such that you have to be very picky in what you want to invest. Right? There are opportunities in the global side on mining, which I think there was a participant that asked this question also of global mining. So that definitely is an opportunity for investors that can take advantage of. But there is a lot of money that just keeps going into the same parts of the market across the world. How does a huge inflow of money affect the particular mutual fund performance in the future who have performed well? For example, in your slide, if you see PPS received a lot, but in the last, see, it doesn't affect. What you must see is that money is going there, no? It's not that it will affect performance. Money is going there. You should be aware of the money. Where is the money actually going, right? Irrespective of whether they are performing or not performing, right? There were parts of the market that you saw within the entire AMC part that the equity value is actually going up, right? But not a lot of money went in, right? Why? Right? Why is it that one is being treated more than the rest when there is evidence that they have done extremely well? These are questions that you should ask. That yes, see, this particular point on money going up and it will affect performance is not valid anymore because a lot of money has been coming in and they've actually proved saying yes, active management does actually go out and start working. Right. So that question of managing more money comes only in parts of the market that cannot take more money. So for a large cap fund, it doesn't matter if you keep on flowing in more money because it's large cap, right? Large and mid for that example, right? It doesn't matter. But for a small and mid cap, when you put more and more money, they are constrained within 250 to 500 basket that they have to put money only in these particular parts of the entire market. right? So whatever came as growth in the last couple of years, then you're just chasing, right? So then one guy chases, everybody will just chase the same thing, right? So you have the tendency to lose out on opportunities because as and when more opportunities are getting discovered, then the scope of you making money goes down. Everybody is doing that, so then the next guy earns lesser, the next to next guy earns a lot more lesser, right? Inflow only affects parts of the market that are extremely constrained, that cannot take up that amount of money, and that amount comes only in the small cap, micro cap, mid cap space, right? Reasons behind fund house allocating more money in NBFC compared to private bank. NBFC, see, not very strict in terms of regulation, right? They've taken off good market share, uh, from private banks, so naturally they were rewarded more. Uh, but across the board, right? If you see credit growth, it's opened up the market, so everybody is borrowing from anyone. So today, if I have to go buy, 1,000 rupees shoe on Mintra, I get a loan. So it's made credit has become very easy. So whoever has been able to take the market share is actually getting valued, right? And this scenario of interest rate also is sort of benefiting them. Which fund do you suggest to invest now? Get onto the platform. Again, get onto the platform. First is your first line of defense if you're covered. Second is what your savings. Be aware of what your savings potential is. Know what your financial health checkup result actually tells you. Third is when you will look at where to invest based on your particular risk profile. Right? Is there a fund that invests only in telecom? No, they invest in telecom they have to have a diversified approach. So they definitely will take this on. If you saw from the chart also, there is a good amount of overweight in the telecom space. One question: SIP or lump sum? First, SIP. Keep some money in hand always for lump sum. That money you can keep somewhere in your savings account or your arbitrage, wherever you're suitable, wherever it's tax efficient for you. Right? Have money that's there as lump sum. As and when you see dips start coming in, take advantage of the dips. SIP first is SIP yearly whenever you can, depending on your earnings. Try to step it up. If you're able to step it up, that's very well good for you. That's very, very good for you because you can reach that particular target and milestone of 1 crore a lot more faster than somebody else can, right? And have some money always ready, that if dip comes in the market, you can take advantage of and put it uh, uh, as part of your savings basket. I have MF running for more than 10 years. Now I want to draw 10K every month. This is basically to draw profits and not to spend. This is yes. So are you close to your retirement? I think it's a one-on-one conversation that we need to have, depending on your goal. But definitely we can plan for something. Just send us a hi. This is a one-on-one thing. It's a case for you. So I think we should have a one-on-one conversation with the team. See, lump sum works when chips are down. SIP works always. So when the chips are down, definitely lump sum is more preferred. When the chips are not down, then SIP plus step up, consistency and boring is what you should be doing. If two mutual funds are operating in the same sector, large cap, and one getting more inflow and higher AUM, and the other is not, which is preferable? It doesn't matter, because what matters is the quality of the portfolio. If the quality of the portfolio is good, we will support them. If the quality of the portfolio is definitely good, you should be willing to support them, and we are definitely advocates of supporting them, and we have supported them in the past as well. How to download historical NAV? Amphi, historical NAV, you'll get everything. Or you can just go to Money Control or Value Research, look at the chart. That's it. Don't try to time, you can get wrecked. Are Chinese FOs worth looking into, or there is a risk that their government is interfering? For somebody who uh, should, so as just from a risk perspective, right? They are going through a transition of old economy to new economy. That will take time, but If you can weather based on your risk profile, right, then it's an opportunity worth looking, right? Otherwise, if you cannot weather it, if you do not have the risk appetite, then just stick to what you know best and what you do best until that opportunity becomes even more attractive for you, until you start maturing as an investor. Then you can have a worth look at it. What is the actual real inflation in South India? I don't know. Considering what is the I don't know for South India. Considering that what is the return that we are expected to beat the inflation, 9 to 12% is very comfortable for you. 12 to 15% is very good as at a compounded level. Anything beyond 18, then hats off to you. That you've done a fantastic job. I think Prashant Jain is one of those investors who has done a fantastic job by compounding at very high levels over 20 years of time. And there was a period where he had underperformed. The funds were underperforming, and a lot of backlash was given to him by the entire, by investors, by the entire industry, because of course it was more public sector oriented. But 9 to 12 base case extremely good. 12 to 15 very good. 15 to 18, 18 plus, then hats off to you. Why is the merger affecting his valuation? Usually when there is such a big merger, costs go up, and it takes time for synergies to take place. Until then, there will be lack of support from the entire market. De-dollarization takes momentum. USA debt increase. Many OPEC countries showing interest in BRICS. Many countries showing interest in BRICS. Okay, many countries started accumulating and buying back gold. Poor demand, domestic consumption. How do we connect these dots, and what is the inference for the investor? Have an alternate currency is what I would say. When you are having a scenario of high debt, you need high inflation to erode that debt. Right? That's number one. Second, developing nations are becoming much more stronger now. Because they are commodity rich. So, and they are the only part of the entire world that is giving you growth. Right? So, good demand, good consumption is coming only from this side, right? From the developing market side. When such scenarios take place, you need to have an alternate currency, because alternate currencies tend to get repriced in this particular scenario. Again, I'm telling repriced, right? It's not re-rated, repriced, right? They just get revalued again, right? And in this scenario, you need to have an alternate currency. That alternate currency that is very well known is on the gold side, on the silver side, majority on the gold side. So when you want to connect the dots, you connect the dots and then make sure that you have a multi-asset approach. Don't be closed-minded only towards equity. When you have a multi-asset approach, then you know that yes, these are opportunities for me to take advantage of. You want a short background about myself? So I've been at I thought for 6 years, and I have done my PGP in portfolio management from National Institute of Securities Management, uh, and I'm in the investment strategy team. So the role of the team is where to invest, how to invest, and when to invest. Right. So it's a lot of allocation that we do uh, based on research internally and externally. So the team is headed by Sham sir, and he's the one that calls the shots and says that yes, we should be doing this, and we are the support team. I was not really prepared for that question, but thank you. I am in mid-age and ready to take risk. Which equity fund would you suggest? No, no, no. You can be ready to take risk, but the risk test is not an interview. The risk test is it's a calculation based that will help me determine or help the team determine your ability to take risk and your willingness to take risk, right? So you might be willing, but you might not have the ability. Rather, you might have the ability, but you might not be willing, right? So send us a hi. We will get the risk test plus all the other health checkups done, and only then we can do. When you go to the doctor sees everything and only then writes a prescription for you. Otherwise, for anything and everything, people are now taking Dolo, headache, Dolo, body pain, Dolo. Not like that. Send us a hi. Where can you contact? Just send a hi on this number. The team will get in touch with you. They'll help you. In fact, the industry is facing a lot of KYC issues also. And I just did a video, I think yesterday or day before yesterday. I think it will come out in a day or two. I'll ask them. But it's on KYC only, and how our team is also working very hard to make sure that you are aware of your KYC status, guide you through the process. If there's any gap, try to fill that gap and make sure that you're KYC compliant, so that you can take advantage of new investments that you make. So if you have existing folio, you can make investing. But what if you want to add a new fund or add a new idea? The SEBI mandate is that your KYC needs to be validated if you want to have a new folio. So even that, we are working in day in day out, to get your account KYC compliant. Right. So just send us a hi, and somebody from the team will get in touch with you. What is your view on SEBI's rule on financial influencers? I don't know. Honestly, I don't know. Will you get a recording? Yeah, you'll get a recording. It'll come out on YouTube. Is there a seminar planned by Sham Sautavan like he did in August? Yesterday he did a Facebook Live. So he does webinars. I mean, he does come in on Facebook now, and he does come on live. So if you're following us everywhere, you will definitely get notifications and marketing communications from our site saying there is a session. So if you want to join in, if you're interested, do come in. How was that everyone? And I thought it's being given fancy big titles like minimum VP onwards. I'm actually lured, as even after 30 years of experience, I'm nowhere near you guys' title. Kudos to I Thought Management for fixing title. See, we started off very small, and it's a big responsibility, I would say. And interacting with everybody that comes on here also is so for example, there's a 3 o'clock also scheduled for me after this, right, where it's a closed group for one of the sales executives that said help me out, we should have a conversation. So it's a very big responsibility, and as custodians of wealth manager also, it's a very big responsibility. Right? Transparency is what we aim to give you, and that's what I hope that we've done a very good job of being very transparent. Diplomatic answer. No, that's the real answer. It's not a diplomatic answer. Because if I'm not being objective in giving you, some sort of a recommendation, then I'm failing in my duty. We need to omit the fund house itself just for a fund manager's front running mistake. No. Is very well aware. So as of now, nothing has come out. So they have come out and they have told a lot of clarifications as well. So let's see how things play out. Is silver ETFs attractive for hedging? Silver ETFs are attractive as investment ideas, and not only for hedging. There's a big chunk of Q&A I think that I've missed out on. Okay, I think it's covered. Right. So, silver ETFs are not only good for hedging. The silver ETFs are very good ideas itself. Thank you. Do get onto the platform. When we go through the data, we find that yes, a lot of you have been supporting us from the beginning, and thank you so much for your support. Thank you so much for spending 1.5 hours of your time on a weekend, coming in, showing this particular interest, and that's what drives us to sort of serve society a lot more with a lot more inspiration, with a lot more motivation also. So thank you so much for joining in. Have a great weekend ahead. Silver undervalued compared to gold? No. Today both of them are trading somewhat fair. Can I hold my SGBs? Yes. Thank you all. Thank you all for joining in on a Saturday. Have a great weekend ahead. Thank you so much. If I missed out any question and if you have further questions, also just get in touch with us, and somebody from the team will definitely get in touch with you. I've done a webinar that to show uh, gold, silver. So you must definitely have a look at it. Go just go to YouTube, Milestones2Wealth live. You'll get like it's a library of webinars. It's a huge content. What are the parameters to be kept in mind while selecting mutual fund scheme? Quality and valuation. So you have a fundamental base, which is quality, and you have a valuation base, which is again somewhat sentimental. No charges in Milestones2Wealth. It's zero. We choose regular mutual funds. So whatever commission comes to us from the AMC. You don't pay a single rupee. It's a regular mutual fund distribution. Commission itself is now close to 2% or high. No, no, you are wrong. Those were back in the day. As and when AUM starts going up, the expense ratio will come down. That's the mandate for expense ratio mandate, right? New one. So naturally, when the expense ratio comes down, you don't earn much as mutual fund distributors. So we have never been of the fact that we should invest money to make commissions. So you can actually go. I think Amphi only has one. I think it's somewhere within the website itself. You should go and have a look at it. You'll have the AUM, you'll have gross flows, all that, and then you can calculate by yourself. I don't know about unofficial. I'm looking at official data, so I can't comment on anything unofficial. But for us, we have not been more commission oriented. So, for example, we are advocates of gold and precious metals. Precious metals में no क्या commission? FOF gold FOF में क्या commission? Nothing. So most of our uh, whatever we are saying has nothing to do with the commission. So whatever we get, we get. But it's not the driver of our for us to take a decision. Quality and valuation is what we decide on. Contact number displayed in WhatsApp. This is the WhatsApp number also. Just send us a hi. Somehow we are having very long interactions nowadays. It's a good trend that you must also follow. Well, I don't think that there are any further questions. So I think I'll close the flow for Q&A. And okay, sorry, one more. Index fund expense ratio is 0.2, but regular fund is 1.5. By looking at historical NAV, the difference in no, never calculate like that. NAV, the expense ratio already gets captured in the NAV. It's not at the end of the day 20 minus 1 or 18 minus 1, never like that. It's already factored in. What the NAV gets published on a daily basis is what the expense is already factored into it. So that's a very wrong way to look at how expense ratio is, and that's a wrong way of you calculating your performance. Right? It already gets factored into the NAV, and that's what they publish on a daily basis, right? It's X of their everything gets factored into that. Index fund is not better. Index fund is see, as a concept, it's very good, passive investing. But index funds are backward looking. Index fund is very backward looking because so the mandate for the benchmark is set in a particular manner. After performance has come in is when you see it coming into the benchmark. So when income for I thought is given by MF, in that case, how can we trust that there is no conflict of interest? I won't be so transparent every time now. Then if there is a conflict of interest, or won't be so open everywhere. You know, telling you that yes, this is what we are doing, this is what how you can do. You can do it by yourself also. But what we are doing here is not just selecting funds for you. No, we are guiding you through the entire process of your wealth creation journey. So that's more important for us than what we get from the MC. Because if you look at the tone also of my entire thing, it's more to do with how you can get to 1 crore, right? Because it's not that hard. You just need to be consistent. Virat Kohli won't be Virat Kohli unless and until he there was a good practice session that he was doing for years and years and being consistent and being boring, right? So whenever we have done this, right, whether it is a boring concept, it's more like, okay, these are stocks that I want to invest in. But usually investors, they don't look at that part to say that no, it's a concept, right? It's a concept. So for us, your relationship matters more. That's more valuable than it is for what we get. The entire industry works out this way, right? For anybody doing regular funds, you will definitely get as commission. But for us, it's more of being a part of a wealth creation journey. What is the minimum? No minimum amount. You can start with whatever you want. See, this again depends on what is the percentage return we can expect in Milestones2Wealth. See, what I want to set as an expectation is that things will be tailor-made for you, right? So if you have a particular goal, you have a particular milestone, and once we do all the health checkup, financial health checkup, and everything, then we will set a plan. After we set the plan is when you would know what that expectation is, right? Anybody looking to invest money in mutual funds having a multi-asset approach is what we also do with a multi-asset sort of an approach, right? Should assume over a very long period of time, that is 10 years plus, as 9 to 12%, right? You should have that as a base expectation, right? Because now we don't know the total information, right? The entire information about what your particular milestone is, what your particular goal is, what your risk-taking ability is, what you're currently saving, and how we can help you reach your savings potential. Only then we get into asset allocation. After we get into asset allocation is when we start parking money across the board. If there is no reason for us to park across the board and park it only in one particular avenue, then we park it only in one particular avenue and then set that expectation from there, right? But in history, multi-asset approach has given you somewhere between 9 and 12%. Right? In the RIS service that we used to have, we were growing at 14.5%, 15% over 10 years and plus. Second, in the last 4 years for MFD, that is mutual fund distribution business, we have been able to compound north of 18.5%, but that's not the number that you should be looking at, right? That is what has happened what we are expecting going forward also in the market is somewhere between 9 and 12%. Right? Our aim has always been to grow somewhere between 12 and 15%, but 9 and 12% is what you should expect as an investor. And keep money in debt fund, and in one day market falls, we can invest on that day, because debt fund closure will come in the next day. We will miss a chance. Am I right? See, if you do it before a particular time in that day, you will get that day's NAV. So I think it's two. You do it at 12, you will get that day's NAV. You will get. You will not get next day NAV. You will get that day's NAV. So you won't miss any chance. Government say inflation is 7%, but we feel like it's 10 to 12. You don't feel like it. You are already going through a household inflation of 11 and 12%. You go check your expenses, see what has grown for you. Let me know. Text us what your particular household food inflation has been. Then you will know. And your expenses outside. When you go for a movie, how much you pay for the popcorn. I have started to keep track of it because it's burning a hole. So the household inflation is higher. Government inflation is what is that number, that basket that they're tracking. That definitely is uh, uh, somewhere between 4.5 to 6%. But yes, your household inflation is higher. So you can check by yourself. When you look at your finances, you will know that how much has your expenses gone up by for the same thing that you've been consuming. Okay, so now I'm officially closing the floor for Q&A. Thank you all for joining in and staying up until the very end. We'll definitely meet next weekend. And next weekend onwards, it will be more vernacular oriented. So a lot of catch up for vernacular will take place regarding. So you will see some repetitive content. So if you're interested in it, please do join in. But we are starting a series for vernacular content, and you will see a lot more participation from our team. You would have already seen them in reels. You would have already seen them in the insurance webinars. You already seen them in the planning webinars. So we have a very good roster, and I'm very excited to sort of present you that. Then thank you so much. Have a great weekend ahead. Thank you.